Hello and welcome. Today we are going to be discussing the most boring things that I know about U.S. Customs bonds. My name is tzaichkin. I'm the National Sales and Marketing Manager at TRG, and I've been working in this industry for about 5 years, learning the ins and outs of customs bonds. I'm very excited to share with you today the information that I know and probably the most boring parts of it, but before we get to that, I want to quickly introduce Trade Risk Guaranty. We are located here in beautiful Bozeman, Montana, about an hour north of Yellowstone National Park. We've been doing this for 25 years, working directly with importers on customs bonds and importers and exporters on cargo insurance. After the webinar, please check out our Facebook group, International Trade Professionals-TRG. We use this group to aggregate all of the questions from our different webinars and answer them for the entire international trade community to see. This is also a place where you can communicate directly with TRG as well as other importing professionals. If you have any questions during or after the webinar, please submit them either in the Facebook group mentioned below or in the comments section of this video. Someone from our team will answer your question right away. Let's get right into the presentation. Today we're going to cover 3 different topics. First, the difference between single transaction and continuous bonds, how to determine the correct importer bond size for your company, and finally, how multi-year pricing works. Before we get into these topics, I first want to cover what is an importer bond. An importer bond is a financial guarantee that ensures U.S. Customs will receive all duties, taxes, fines, and penalties on goods being imported into the United States. If an importer can't or won't pay, the bond is there to ensure the government still receives their money, at least up to the bond amount. It is the most common bond type, and again, it is a financial guarantee. There are 3 parties involved and only 3 parties. First, Customs and Border Protection. Next, the importer of record, and finally, the surety company. Now that we know what a bond is, let's talk about the difference between a single transaction and a continuous bond. A single transaction is just that, a bond for a single shipment. It is filed at the port of transaction, and it's really just for that shipment alone, for that consumption entry. So therefore, it does not satisfy the ISF bonding requirements, only the consumption entry requirements. A continuous bond, on the other hand, is for numerous shipments. It is a 1-year policy term, and it renews automatically. Rather than be filed at the port of entry, it is filed electronically and centrally, and can be used at any port. This bond meets both the requirements for consumption entries and the ISF filing. So let's discuss how to determine the correct bond size for your company. When determining the size of a single transaction bond for your company, the calculation is fairly simple. The bond must be no less than the total entered value of the goods, plus all duties, taxes, and fees. The bond must be written at a minimum of $100, and the size can be dictated by the port director. For example, if your goods are subject to PGA regulations, the bond may be required to be 3 times the total entered value. Continuous bonds, however, are calculated differently. Rather than look at the total entered value of the goods, a continuous bond is based on the duties, taxes, and fees you pay annually. It must be written at a minimum of a $50,000 bond, but the calculation comes down to 10% of the duties, taxes, and fees paid annually at a minimum. We look at that value and then round it up to the nearest 10 or 100,000 depending on the number that you pay annually. Risky or non-compliant importers may be required to place a larger bond, and that can be dictated by a port director. Let's look at the formula for a continuous bond. First, take the total duties, taxes, and fees that you pay annually and multiply those by 10%. If those total duties and taxes are between $0 and $1 million, we round up in multiples of 10,000. If it's over $1 million in duties, taxes, and fees, we round up to the nearest 100,000. By looking at the chart on the right, you can see the different sizes of the bonds. For example, if you pay between $0 and $500,000 in duties and taxes, you would need a $50,000 bond. $500,000 to $600,000, $60,000. $2 million to $3 million, $300,000, and that's again because we round up to the nearest $100,000 if we're over $1 million in duties and taxes. Let's go through a few more examples. First, with a single transaction bond. If the total entered value of the goods is $25,000, and at a 5% duty rate you pay $1,250, and your fees are $86.60 for merchandise processing and $31.25 for harbor maintenance, the total bond size you would need is a $26,367.85 bond. Moving on to continuous bonds, we look at the duties and taxes, so it's a little bit different. With the first example, with an annual value of goods of $1.25 million, and annual duties, taxes, and fees of $68,392.50, we find that using the calculation of total duties and taxes times 10%, we need a bond size of a minimum of $68,339. By rounding that up to the nearest 10,000, it would be a $10,000 bond. However, because the minimum bond size for a continuous bond is $50,000, that would be the bond size appropriate for this company. Moving on to the next example. With annual value of goods of just over $15 million and duties and taxes of $828,000, we find that 10% of that amount is $82,864. Rounding up to the nearest 10,000, a $90,000 bond would be appropriate for this company. For a third example, let's look at double that volume. So this company has an annual value of goods of just over $30 million. That turns into duties, taxes, and fees of $1.65 million. Now, 10% of that amount is $165,000. By rounding up to the nearest 100,000, we find that a $200,000 bond would be appropriate for this company. That's because their total duties, taxes, and fees annually exceed $1 million. Now, in all of these examples, you'll see that we didn't discuss the number of entries that these companies had. That's because a continuous bond is not based on the number of entries. You could have 1, 10, 100, 1,000 entries, and it wouldn't change the size of your bond. In similar fashion, we also see that we're not talking about the size of individual shipments. That's because a continuous bond is not based on that either. Whether your shipment value is 10,000, 100,000, or a million, it's all based on the duties, taxes, and fees that you pay annually. Let's move in to how TRG offers multi-year pricing in the industry. TRG has been offering multi-year pricing since the early 90s. And you can think of it the same way that your car insurance agent offers discounts for longer terms with your paying for your premium. For example, if you pay monthly, your premium is much higher than if you pay every 6 months. And that's higher than if you pay every year. That's exactly the same model that TRG uses with its bonds. We are not offering a multi-year bond. Instead, we are lowering the price and offering discounts for increasing term length. If you need to term and replace your bond at any time, we offer refunds up to the day. Now, there are many companies offer multi-year pricing, and most offer discounts for extending the term. The ability to offer refunds up to the day means that you don't have to worry. If you choose to move forward with a 5-year policy today, and you need to term and replace 2 years down the road, you know that you'll be receiving your premium back and be able to use that towards your next bond size. Well, today we covered 3 topics. First, the difference between single transaction and continuous bonds. Next, the different importer bond sizes and how to calculate that size for your company. And last, TRG's multi-year pricing structure. I want to thank you so much for being with me here today and learning a little bit more about, yes, the boring parts of your bond. Trade Risk Guaranty offers a very unique approach to the importer insurance market. Rather than work through a customs broker or freight forwarder, we work directly with importers. This saves you both time and money because you're coming directly to the agency issuing the policy. Our multi-year pricing often lowers costs significantly and allows you to forget your policy for 1, 2, 3, or 5 years at a time. You'll notice that with our 5-year pricing on a $50,000 continuous bond, we have some very low options. $225 a year is significantly less than the industry average of around $500 a year for this bond. One great note about working with TRG, we are not a customs broker or freight forwarder, so by working with us, you can continue to work with any broker or forwarder that you choose. In addition, our in-house claims assistance from licensed customs brokers ensures that if something does happen, we are here to help you, and because of our vested interest with you, we want to make sure that claims get handled quickly, efficiently, and at the lowest amount possible. That is what our staff is trained to help you do. Lower those claims amount and handle them quickly. Again, thank you for being here today. If you'd like to reach out and speak with us, please visit our Facebook group, International Trade Professionals-TRG. You can also find us on Facebook at Trade Risk Guaranty, on Twitter at TRG_bond, online at TradeRiskGuaranty.com, and I would encourage you to subscribe to our blog at TradeRiskGuaranty.com/TRGpeak. If you'd like to contact me or anyone else at the company, please feel free to email us anytime at askanexpert@TradeRiskGuaranty.com. Again, thank you so much. I really appreciate you watching this video, and I'm excited to speak with you again soon.